Okay, I wanted to show you a statistical representation of what I'm talking about. Now, the fundamental tenet is investing is a positive sum game, but a zero sum game around the market return. Cost makes the return worse. Now, this is a picture. I've taken this, I've snagged this from Vanguard Canada's website, and it shows a statistical representation of that statement. So I'm going to walk you through this diagram because this is a visual of what I've been talking about, and it's important to note this. So here we have the market return. Now, investing is a positive sum game. What do we mean by this? This is the market return. This is a positive number. Investing is a positive sum game. And let me show you this. I've snagged this from the 2017 Morningstar Index chart, and it shows long-term returns. Here's the S&P TSX Composite Total Return Index with everything reinvested. It has averaged since 1950, so this is roughly a 67-year number. Had you invested 67 years ago, you would have got somewhere in the neighborhood of this return, 9.8% per year for the last 67 years. Some years were 20, some years were negative. There's a lot of crashes in this number, but still the number is a positive number. Investing is a positive sum game. Here is the US, 11.7. That's kind of what we would expect. The US is a more capitalistic nation than Canada. The market return is a positive number. There's fundamental reasons why this is and why it will hold true. We get better at what we do over time and generations, and companies are continually reinvesting in themselves. When a company makes a profit, what do? They give some to shareholders in the form of a dividend, and they reinvest the balance. Okay, so investing is a positive sum game, but a zero sum game around the market return, and that is represented by this bell curve here. The definition of a bell curve is it is symmetrical. That means the returns on this side of the market return are exactly offset by returns on this side of the market return. Now I'm going to introduce cost into this. What does cost do? Cost shifts the whole curve to the left. The investment return gets lower as we go to the left. So to make this a little more intuitive, let's put a number on this. Let's say the market return is 8%, and let's say cost is 2%. That means the market return pre-cost is 8%, post-cost is 6%. Now there is a zero-sum game around the post-cost market return. That's important. It's still a zero-sum game. Cost has shifted the whole curve to the left. So half the money invested gets less than 6% after cost, and half the money invested gets above 6% after cost. Now those are the active investors. There's a distribution around the market return, a symmetrical distribution around the market return. What do the passive investors get? There is no distribution around the passive investor because by definition, the passive investor gets the market return pre-cost, subtract cost, and that's what their after-cost return is. So each passive investor gets this red line, and the difference between this red line and this line represents cost to the passive investor. Let's say, to make this a little more intuitive, every passive investor pays a 15 basis point cost. They would get 8% pre-cost and 7.85% after cost. This gap would represent 15 basis points of cost. Now, who would you rather be in this pictorial? The active investor, where there is a zero-sum game around 6% in our example, or the passive investor that gets a certain 7.85% in our example, And our example is an 8% market return. Now look at the active investor. Some of the active investors will outperform pre and post cost, and that represents these individuals here that have a return in this category here. So these returns in this shaded blue area are active investors who have outperformed pre and post cost. But look at all the active investors who underperform the market return, or let's make this simple. They underperform the passive investors post cost. This group outperformed the market return and the passive investor before cost, but underperformed after cost. This group underperformed pre, and cost just made it worse. So when you look at it this way, ask yourself, who would you rather be? The group of individuals who get this return, the red line, or the group of individuals who have a distribution around this blue line, which is further to the left? Now, if we go with the 2% active cost and 15 basis point passive cost, this gap here represents 200 basis points, or 2 full percentage points. This gap here between the red and the blue line represents 1.85 percentage points, or 185 basis points. So that's it. The key thing here is that there is a zero-sum game around the market return pre-cost and post-cost, and cost shifts the whole curve for the active investors to the left. This makes sense. Remember that every share outstanding is always owned. So there's the active investor. What do? They use skill, they use intuition, and they use research to over and underweight companies in the market. Well, if you want to overweight a company in the market, you have to find someone who is willing to underweight a company in the market. So the two offset. At the end of the period being measured, there's been two bets made here by two participants. One is overweighted, one has underweighted. At the end of the period being measured, one has paid off and the other one was a bad bet. One won and one lost. One individual won and one individual lost. The outperformance is offset by the underperformance, or vice versa, the underperformance is offset by outperformance. It seems intuitive to me that I would rather get this return than try to get this return, because I know the odds of me getting this return are less than the odds of me having a return somewhere in this distribution of returns. Okay, so the next video I'm going to look at data. The theory is sound. What does the data say? Thank you for watching.